Good afternoon, traders and investors. Will back here with another one, coming to you with a Sunday video, guys. And it's that time of the week again where we go over the top 5 options plays for the upcoming week. Hopefully all of you had a very nice weekend so far. Now keep in mind, all of these options plays are going to be for selling options, more specifically for selling put options as part of the larger wheel strategy that I like to run on the channel. It's a very easy strategy to run, whether you are a beginner, intermediate, or even advanced investor. It allows us to basically place buy limit orders under the market, and even if we do not get assigned those shares, we get to collect some very juicy premium. It's a strategy that does not require a lot of time from the part of traders and investors. Also, it's a high win rate strategy and somewhat of a risk-averse strategy as well. And especially in times when the VIX is high and uncertainty is high, we get to choose strike levels that are well below the market, which really ensures that we're buying stocks where we want to buy them. So in today's video, guys, we're going to go over a few things together. Number one, of course, we have to do a preview of the upcoming week. We know the recent weeks have been extremely volatile due to macro policy uncertainties, and this week we have a very big catalyst coming, which is going to be the Federal Reserve interest decision meeting, where we get to hear from Jerome Powell and his opinions and stances on the current market conditions. So we will do a quick little market preview in terms of the economic things to look out for, and also some brief technical analysis on the indexes. Are we maybe looking for a bounce, even if it is a dead cat bounce, so to speak? Are we possibly looking for a bounce into this week? Or are we looking for possible downside? We'll take a look at that in the first part of the video. Thereafter, we're going to go over the strategy rules very briefly, but I want to spend a good 4 or 5 minutes recapping the strategy rules just as a quick refresher, especially in times like these. We absolutely need to respect the strategy rules, guys. Those are what's going to keep us alive amidst all of the volatility. And lastly, of course, we're going to take a look at the top 5 options plays. And as per usual, I have a ton of bonus plays for you guys as well. So make sure you stick around to the end. So without further ado, let's jump right into the action, shall we? So in terms of the expectations for the week, well, we know number one, that the fear is quite high in the markets. Fear and greed index is at a very low read of 21, and there's not that much market breadth overall. Yes, we had a very nice day of bounces on the Friday session, but if you look at the 1 week, everything pretty much down in the gutter. 1 month, not much better, everything down in the gutter. But what does history tell us about times when the market collapses in a very fast way and when so many stocks are in oversold conditions? Look at your percentage of stocks above their 20-day moving average at a very low read of 26%. Historically, it's always been a very good time to go shopping when this indicator hits the lower end of its range. Percentage of stocks above their 50-day moving average, as well a low read of 26.86%. History tells us as well, all the way 15 years ago, throughout the market crashes or corrections, whatever you want to label them right now, it's been a great opportunity to buy. So at least these short-term indicators show us that the market, broadly speaking, is somewhat oversold. This is great news for us if we're looking to write 1 or 2 week put options and benefit from a lot of this volatility. Another volatility indicator, the VIX. The VIX had a high of almost 30 last week before starting to curl down on the Thursday and Friday sessions. When the VIX is high, you know the saying, it's time to buy, but we still have to be somewhat conservative with our strike prices. And in these options that I'll be giving you later on in the video, we will be indeed quite conservative with the moves. Now as well, there's something to look out for, guys. The SPY coming out of daily oversold conditions, possibly looking for a continuation bounce rally. The technicals do tell us that the bears are in full short-term control, but can we have a continuation of the bounce from oversold conditions, maybe up to the moving averages, SPY 570, all the way up to resistance 576, 580? Yes, absolutely, but it will just be looking for a lower high. So don't get too greedy, guys. We're going to still have to be very conservative with our strike prices when looking for puts. The Qs, same concept. Bears are in full control. Can we be looking for a bounce from oversold conditions coupled with our support area back up to the moving averages 2-3% away and to our resistance range 495 to 500? Absolutely there as well. Keep in mind too, guys, since everybody has been loading up on put options in the past week, you get something that looks like this. This is the average put volumes, or the total put volumes, and you can see over the last 4 years, 5 years almost of data at this point, the highest amount of put buying ever, leading into a monthly contract expiry this Friday, March 21st. So the market makers may play some games. Look at the max pain levels, guys, for the Friday close. QQQs is 499. That is a good percentage above the current markets right now, guys. That would be a bounce all the way up, roughly about 4% to the upside. Why does the max pain matter, and what does it measure? Maximum pain does not mean how far down can the markets go. Max pain means if the stock we're looking at, or the index, closes at this price, how many people are going to end up worthless? it is in the market maker's best advantage to make the most amount of long call buyers and long put buyers expire worthless, so they and the option sellers get to collect all the premium. Now you couple a record amount of put buying with a high VIX and a max pain level 4% above the markets, and you end up with a recipe that could just see the markets bounce and make a whole bunch of people feel maximum pain. The put buyers will expire worthless, and all these out of the money call buyers could even end up worthless as well. That is why, in combination, looking at everything, oversold conditions on the RSI, looking at the max pain levels, the record amount of put buying, the extreme fear in the markets, everybody saying the markets are going to go lower. Maybe the markets throw a little bit of a curveball in that narrative and just bounce for the week. Now, obviously, we're not going to project further than this week, but just looking, if we're going to look at weekly put writing plays, well, we need to consider all of these factors. So keep all of that in mind. All of this is supplanted with not many earnings to move the markets in a big way. No big tech names, no other big consumer discretionary plays like Costco and Walmart. The biggest ones we have are Thursday after the close, Micron, Nike, and FedEx, just to name a few. And lastly, as well, in terms of economic highlights, well, tomorrow morning on the Monday session, we get retail sales for February. It's going to be 0.7, which is well above the one that we got in January, which was negative 0.9. But if this one comes in a little bit weak, because we know consumer sentiment and consumers overall have possibly been pulling back on their buying the last 3 weeks as the Trump administration moves forward with an onslaught of tariffs on one day, off one day, and the reciprocal tariffs coming April 2nd, if we possibly see some retail sales numbers that are weaker than expected, we could see a little bit of a start to the day on Monday in a red fashion. That will allow us to go shopping for some short puts under the market, and then the Federal Reserve comes on the Wednesday session. That's going to be the biggest session of the day, arguably, but Monday could just present us a decent little buying opportunity if we have a long skew for a bounce over the course of this week. But still, even if we might have a slight temporary long-leaning bias, temporary meaning only this week, if the market makers want to make max pain come into reality and bring us out of extreme fear reads for at least maybe 1 week of duration, we need to benefit from these short-term declines if it's possible on the Monday session to be writing puts all the way below the market on some of our favorite companies. That is your market outlook for the week. Hopefully you guys appreciated that. So leading into these strategy rules, I'll be spending a very brief amount of time on these because I have a 30-minute video linked down below in the description. And I'll also leave you to a second video where I go through these 10 minutes. I used to do about 10, 12 minutes on these rules every Sunday, but to be more time efficient now, I'll pretty much refer you to other videos. Now we're just going to be doing a very brief recap of what I look for when I'm writing puts. Now, what exactly is writing puts? You can think of it as a buy limit order that pays you. Let's say for all intents and purposes, I want to buy Amazon, but not here. I want to buy it lower, maybe around the 185, 187 range, bottom end of support, but I don't know if it's going to get down there. Well, that's why we can write puts to open in the market. If you take a look at the Amazon contracts for the week, you will see that in or around the, let's say, $190 range, if I wanted to buy Amazon at 190, but I don't know if it's going to get there by the end of the week, I can write this put option, which guarantees that I will have to buy 100 shares if the price closes below 190 by the Friday session. If it does not close below 190, I get to pocket about $115 for locking away that capital for that buy limit order. If it closes below 190, well, I have to buy 100 shares at 190, but I still get to collect the $1.15. All right, so you're basically getting a discount of $1.15 per share or $115 total for that order. That is why I like writing short puts, guys. It is a buy limit order under the market on stocks that we want to buy anyways, but we're just not sure if it's going to hit that level by the Friday session, right? Now, number one, in terms of what we want to do, we want to build a watch list and filter by red. Every day when I'm looking to shop for puts, I'm not chasing the market to the upside, guys. I want stocks that are down. So it stands to argue when you build your watch list of companies that you want to trade, well, we are always filtering by red. That is step number one. Step number two, guys, high quality, high conviction companies only. I think you know it by now. In these market conditions, you don't want to be trading just anything. You want to be going with the highest quality, highest conviction companies in the world for you. Do not deviate from that strategy, because if you get caught having to buy some shares, at least you want to have high conviction in the shares that you've purchased and not wonder what the hell you're doing in that company in the first place. Number two, we're looking for stocks in monthly uptrends or long-term ranges. All the stocks that I'll give you are at a combination of the two, either monthly uptrends or the long-term ranges, meaning that the longer-term bulls are still in control. Number three, the stock needs to have no earnings this week. You guys have seen over the last year how volatile these earnings reports are. A stock can have very good numbers and still go down 10, 15, 20+% in the after hours after their earnings. If you want to avoid any outsized losses really fast, do not write any put options ever on companies that have earnings this week. It is just not worth it. Number four, we want to be writing stocks at weekly support areas or areas of breakout retests. Now, a weekly support area, right, I always bring up this one, is something like an Autodesk. It has to be such a massive support level that it hits you in the face. This is really 2 years worth of support. Every time it pulls down into this location, it was a good opportunity to be writing put options at the lower end of the range. A breakout retest is a little bit different. It's otherwise known as the trend continuation trade. I'll show you what that looks like when you get a breakout of a range, the breakout, the retest of the high end of a range, and the run. This is either a breakout retest trade. Some people call it a trend continuation trade. It is a very high probability setup. All the trades that you see me do are always going to respect one of those two criterias, guys. It puts our odds in our favor of not being assigned. Now, number five, we want to be writing at or lower than the expected move. If you don't know what the expected move of a stock is in a given week, you go to this website right here, barchart.com, just type it into Google. Bar chart, expected move, then whatever stock you want, you will come to this page. As you see, I have Amazon. If we come down here, the expected move for Amazon on the week is 191.58. We always want to be writing below the expected move. This is the probabilities that Wall Street attribute to a stock's ability to move up or down in a given week. You can see the expected move is 3.22%. If we're always writing below the expected move, guys, it once again increases our chances of not being assigned. Now, number six, we want to be writing on a red or flat day. I already told you about the watch list, but as we said, right, if we're looking to write puts under unexpected move, well, it stands to argue the stock needs to be red. If it just blasts off on the Monday session, the expected move is down here, we're not going to be able to write below. You want it to come down into the expected move so we can write below the expected move and once again increase our chances of not being assigned. Now, the next one here, 0.5 to 0.75%, this is your take-home pay. This is what we look for in terms of weekly premium. If you don't know what 0.5% means, it means that when we are looking at these put options, guys, you want to be finding at least 0.5% for that order. That is the sweet spot. In my last 6-7 years of running this strategy, I derived the 0.5% rule to be the sweet spot between high probability trade setups, high win rates, but also a very decent level of take-home pay. If we're writing always 0.5%, that means that we're going to be getting about 26% annualized on the capital that we're doing if we do this every week for 52 weeks, right? So 0.5%, very easy to follow, guys. You are looking for half of the strike price in cent increments. Half of 190, right, is roughly 95. If you do the math, 95 divided by 190, it is literally 0.5%. As you can see right here on the 190s, there is more than 0.5%. You do not want to be going too close to the market, even though the premium here looks very fat and very juicy. Do not get seduced, guys. If you go too close, you run the risk of being assigned at a somewhat unfavorable level. So you want to stay close to the 0.5% range. If you want to just do the math, guys, you can go through a ton of options chains extremely fast. Look, I'll pull up NVIDIA. Where's the 0.5% rule? Well, very easily, right? Just divide the strike price by 2. You should be looking here at half of 110 should be 55. So you see this is still a little bit too rich. Where's the 0.5% rule on NVIDIA for this upcoming week? Very simply, guys, you go all the way down until you find it, right? Where's 0.5%? You're looking for roughly 55 cents. You can see that right now it is currently standing at the 108 strike. That's how you know this is the optimal level to be looking to go shopping for, right? So keep that in mind. Now, number 6, we want to be taking, or 7 rather, we want to be taking profit at 90% of the contract value. Just make sure we're being capital efficient. If we write these options on a Monday or Tuesday morning, and by Wednesday afternoon, they're 90% profitable, we do not need to hold them into Friday. You may as well just close the trade and then go shopping for something new that has full premium. Now, in this type of market, guys, right, to focus on high quality, I've added 2 extra rules. When you're looking for a stock, because all of you want to have eventually 7-figure, 8-figure accounts, right? Well, you better start trading like it right away. If you're choosing to write something, would you do that exact same trade with $300,000 to $500,000? All of you want to be having $1 million accounts, right? Well, when the wheel gets that large, all of these positions are going to be 3 to 500K. Would you do it with 500K? If the answer is no, maybe it's not that high of a quality stock for you. At number 2, always plan a DCA 15% lower. If you do not have the money or conviction to DCA if assigned 15% lower, then maybe it's just not that high of a quality stock for you. And then if ever we get assigned, guys, you want to be writing covered calls. This is to get into a stock under the market. How do we get out of that trade? We're going to be writing covered calls against the position. Covered calls, same rules, 0.5 to 1% per week in weekly premium. And we are going to be writing at our assigned strike prices or one strike price higher. That is a recap of the rules. If you want a longer recap, the 2 videos are down below in the description. Now let's get into the plays, shall we? So if we're looking at play number 1, I'll throw to you guys a couple of banking stocks. Number 1 is a digital bank that a lot of people like and I like as well, especially at these reduced pricings. And it is SoFi. SoFi, the valuation right now is very manageable. Keep in mind this bank is now profitable as well on a quarterly basis for the last 5-6 quarters. And additionally, when you're looking at EPS expansion, trending to the upside and revenue trending to the upside as well. Now, this company is only currently worth about $13 billion, which means they're trading at roughly a 4.2 to 1 in terms of price to sales. That is very attractive. Combine that with the fact that we're hitting the IPO prices again, previous levels of resistance for the market, which are now support, and a lot of long-term moving averages there as well. The $11 range down to roughly $9.50 is the area that I want to be picking up SoFi shares if it's a high conviction stock for me, which it is. Now, if you don't like this one, I have many more plays, but just for those of you who are looking to play SoFi, the expected move for the week is 11.36. Let's go shopping to see if we can find some premium on SoFi below the expected move. So let's pull it up real quick and we'll go shopping together. As you can see right here, at $11, there is currently almost 1%. That is very good. Keep in mind, we don't have many strikes on SoFi. The $10.50 ones are actually 0.5%, right? Half of roughly 10 is 5. You're getting 5 to 6 cents. I know it's not a lot of premium, but it does respect the rules. If you're a little bit more risk on, you want to go for higher premium, the $11 strike also respects the rules and it is below the expected move. Now, be dynamic with these strikes, guys. If SoFi drops on a Monday or Tuesday morning and you're patient enough and it drops back down into the 11s, well, then you may get more premium on the 10.5s. So the optimal strikes are $11 down to $10. With this strategy, you want to be patient. On a red day, you want to try to be getting as low as humanly possible into this support zone. So for me, it's going to be strikes between 11 and 10. If you're an aggressive bull, you might want to do the 11s. If you're more conservative after a drop, you might be looking for the 10.5s, and that would be a very decent first entry into SoFi. Stock number 2 is going to be an actual, well, a legacy bank, Bank of America. Bank of America also out of daily oversold conditions and has come down an absolute ton from its highs. You're talking about top to bottom, almost 18%, and you're coming very close to a huge level of support. Resistance for the markets for a while, congestion area, and right down here is the 200 weekly EMA. This entire zone, 39 down to 36.50, is a fantastic area to be picking up Bank of America. And in the event we get assigned, we're getting a 2.54% dividend the entire time that we are assigned before we can actually wheel out of the position. I'm not saying we're going to get assigned. I'm just saying that if you do have to buy the shares, at least they make it worth your while. That being said, the expected move for this week is 39.73. It's pulled off the lows recently, but if we get shot back down Monday morning for XYZ reason, back down into the lower 39s or high 39s, it could be a fantastic area to target the $38 to $37 strikes. Let's have a look at Bank of America to see what we're getting on the chain as of right now. And we'll be dynamic with the strike prices once again. You can see for the Friday session, the 37 puts are only 6 cents. Now, I took this trade myself, right? I'll show you guys in the trades here. We took Bank of America just the other day here. We took Bank of America on the Thursday session when it was bright red. We got those very same 37s for 20 cents. I was able to close them in one single day for 70% profit. That's what we're looking for. If it drops down again, you might have a free range here of the $38, $37 strike. So even though the expected move is $39.73 and $39 is not a bad strike, for me, it's going to be 39 down to 37, as low as we can go if the markets go red. As of right now, even the 39s are not paying enough premium. Don't chase this one to the upside. If it just runs away, no problem. There's no trade. We move on to the next one. But if it comes down and you can find some good premium on the $38 strike, that would be a very good condition for me. So that is trade number 2 as part of the overall banking financial sector. Actual trades number 2 is going to be a pair of semiconductor stocks, the same ones from last week. Stock number 1 is NVIDIA. Needs no introduction. Coming out of support right now, 111 down to 101. You see how well they've been able to hold this level? Well, that's exactly where I want to write my puts again. Why? Well, because even down there, the price to earnings is only a 25.3 on a forward basis, and the PEG ratio is a 1.10. NVIDIA is growing extremely fast. Their quarterly earnings were fantastic, but we don't want to start chasing it as it continues to move higher. If the bulls get sent down a little bit on the Monday or Tuesday session and we start moving down towards the expected move, which is 114.88, that is going to once again free up some fantastic strikes. If you were watching my video last week and benefited from these declines on the Monday, a few members of my Discord, they were able to find some strikes in the $96, $97 range. They were able to close that trade only a few days into the week for 80, 90% profit because the volatility is so high. You get one big red day, you write all the way down here. And then if you only get 1 day or 2 days worth of bounce, you're out of the trade. And if we're going to get assigned, at least we're getting assigned NVIDIA in the lower end of the range, which is like what? 95 down to about 85 bucks. Very decent first entry for a position on NVIDIA. At least I think so. If you don't think so, then you don't have to take the trade. None of this is financial advice anyways, right? So moving on down, if they pull back into the expected move, 114.88, let's see what we can get on NVIDIA stock for this week if we can already go shopping below that expected move. So as I showed you before, right? At 114, there's over 1% in premium. This is too aggressive. Even if it's below the expected move, it is just a bit too aggressive. You want to be going as low as possible, being conservative in this current market. And to be conservative in this market, we are going to target the 0.5% range. A lot of people like to use delta, but delta on NVIDIA or Coca-Cola or McDonald's, the delta is going to be different. We cannot use delta for everything and say, oh, we'll just go for 15, 20 deltas. They'll be different because the implied volatility on different stocks will also be different. 0.5% rule encompasses the delta and adjusts it depending on the stock that you're looking for. So the 0.5% rule on NVIDIA right now is 108. 108 is significantly below the expected move. You're talking about 6% below the expected move and into support, which stands to argue if NVIDIA has a red start to the week, comes back down into the teens, what do you think is going to happen? You're going to get a lot more premium, lower, closer to 100. So for me this week, we're going to be looking for 106 down to 100 on an NVIDIA drop. Get as close as possible to 100 because at the end of the day, you want to buy the shares as cheap as possible if the markets do indeed come down. So for me this week, 106 to 100, wait for NVIDIA to have a red day. If it starts moving up, I don't want to see anybody start chasing this one above the expected move. Not in this market, guys. Stay patient. Let the market come to you. Stock number 2 as part of the semiconductor trade is going to be TSM. TSM, another fantastic company for 2 reasons. Number 1, this is huge support. 172 down to 158. The valuation right now at around 177 is dirt cheap. 1.14. This is a product company with a commanding market share in what they do. You can arguably call them a somewhat monopoly at what they do. Look at these profit margins, fantastic profit margins, and even their forecasts for the next few years. This EPS is expanding beautifully. This revenue is also expanding beautifully as well. I want to participate when TSM has now had a decline top to bottom of 25%. I want to be bidding in this lower location, but we don't have to be too aggressive with it. The expected move right now for the week is 167.32. Let's go shopping on TSM if we can find anything below that low level of roughly 167. And because the volatility is so high right now, you can see that even at the 165s, you're getting very close to 0.75%. But we want to be going even lower. Look at these 160s. As of right now, they're not paying 0.5%. Half of 160 is 80 cents. However, if NVIDIA has a couple of percentage points move down Monday or Tuesday, you're going to be able to get a fantastic strike, a 160 strike. That is literally, 160, the expected move down there. That's 4% below the expected move. At the bottom end of the range, you'd be getting pricing from all the way back in August for a fantastic company at a fantastic price. So wait for the market to come down, then you get fantastic strike opportunities, guys. That is the name of the game. We want to be dynamic. We want to be patient, wait for the market to come to us, and then bid on our favorite stocks. Now, that is it for your 2 semiconductor plays. Play number 3 is going to be Amazon. Amazon also needs no introduction. It is now down top to bottom from its high to the lows, 21%, oscillating around daily oversold conditions. We always want to be looking at Amazon when it's in daily oversold conditions, especially when the forecast for the next few years looks like this. EPS expanding into profitability now. Right? They really want to focus on shareholder value, free cash flow expansion, and also net margin expansion. Amazon has never done that. They've always been a top-line revenue growth company at all costs. Now they're focusing on the shareholder. Couldn't come at a better time. Look at this revenue expansion. In a few years, Amazon will almost be bringing in $1 trillion in overall revenue. That is absolutely ridiculous. So I want to be buying these dips if I can. Daily oversold into support. Support is 196 to 186. It is the previous highs from back there. You see it more clearly on the weekly time frame. And even if it draws down more, this is first entry, and then we can DCA all the way there at the highs of 2020 and 2021. That would be a fantastic first and second entry if we're looking to DCA into the process, right? So don't blow the whole bag. At this level, you also got to keep some money back if you want to do some down here as well. That being said, the expected move for the week is 191.58. Let's go shopping on Amazon and see what we can find below the expected move, shall we? So if we're looking for below 191, you can see right here, the 190s are paying more than 0.5%. Half of 190 is roughly 95. So if you're seeing 95 cents, that is good. The only problem is there's no 187 strike. It's either 190 or 185. I would not mind the 190 strike on Amazon for the week. However, if the stock does decline early in the week with retail sales, Amazon's a retail-facing company, right? If ever this data here comes in red and the markets start off the week red, Amazon comes down 2-3% into the lower 190s, then you might get the 185s. Quick reminder, you're looking for roughly, you can get a little bit under, but anywhere 80 to 95 cents on the 185s would be fantastic. So depending how aggressive you want to be, for me, it's either the 190s or the 185s. That is it for Amazon. Trade number 4 is going to be Google. Google also a stock that needs no introduction. As you can see, guys, I'm focusing on some of the highest quality companies of their respective sectors. If you don't like Google, no problem. There's a ton of other plays. Google top to bottom declines 21% in a very short time period. And also we're seeing a bit of daily oversold conditions. This as well is what we like to call bullish divergence, right? Lower lows on the price, higher highs on the RSI. Usually it does tend to correct in the direction of the RSI. Might be looking for a pop here on Google. But if ever retail sales starts us off in a negative way and sends Google a bit lower, well, we might be able to get some fantastic strikes, guys. Even though we're at the lower end of the range of support here, the 150s for Google becomes extremely attractive. Even at 165, you're trading at a 1.23 peg. Fantastic net margins, great cloud revenue growth, and also record amounts of free cash flow. Google's profit margins are huge, 27 to 30% on average, and overall, their yearly forecasts look like this. Ever expanding EPS and ever expanding revenue as well, even in the bear market of 2022. Did Google lose any revenue? No, it still went up. Did it go up at a faster clip? Yes, but then again, end of the day, you're buying an extremely high quality company at a fantastic price. It's an 18.5 forward price to earnings, guys. That's literally dirt cheap, yeah? So let's go shopping on Google below 162.69, shall we? Let's pull up the options chain together. Oops, that's not Google. This is Google. That's not Google. This is Google right there. All right, perfect. So if we go looking at Google, guys, below 162.69, yeah? So if we're looking at the 160 strike, as you can see, half of 160 is 80. You're looking for 0.5% here. We're not quite getting it. So what Google needs to do is Google needs to drop a little bit. If it comes down early on in the week, 1, 2, 3%, you might be able to get the 160 strike, which is very good. Your average cost with premium received would be in the 159s. That is fantastic. If Google, for some reason, falls down Monday, 3, 4, 5%, then we look to the lower strikes, 157 or 155. For me this week on Google, it's one of these 3 strikes, 160 down to 155, as low as we can get while respecting the 0.5% rule. That is trade number 4. And trade number 5 is going to be one that everybody should not mind doing. It is the actual S&P 500. Now, I'm not using SPY because, not everybody has, $55,000 to bid the SPY. So we can use something like SPLG. It is literally the S&P 500. It has the same amount of holdings with the same amount of weightings there. You can see the beta is 0.99. It is literally the SPY. It's just, as you know, there are many different ETFs not only the SPY, right? So this one is exactly the S&P. If we cannot at least start DCAing into the S&P 500 when it's down 10%, guys, then I don't know what stocks we want to buy, right? We have to be bidding the S&P 500, especially at such a cheap contract value of $65. The expected move coming out of daily oversold conditions is 64.9 for the week. These are monthly contracts, but the expiry for this week is a monthly expiry. So that being said, if we're looking at SPLG, there's only a few options available to us, right? So if we take a look at the SPLG here, you can see that with an expected move of 64.90, we have only a few options, 65 or maybe 64, which is the bottom end of the range. Prior support as well. This is the top end of resistance from August, should be newfound support. Couple that with daily oversold conditions, very decent entry if we're to be assigned down there. So if you take a look, you will see that the 0.5% rule is being respected at 65. That is roughly the expected move. However, if the indexes start the week on a red note, maybe, just maybe, you get access to the 64s. You can maybe be looking for slightly under 0.5%. I'll allow it just because the markets are so volatile and we want to be getting the best possible price. If you can find 25 to 30 cents on the 64 strike with a little dip on Monday, that would be a very decent first entry into an ETF that nobody should mind holding in their portfolios, which is the S&P 500, right? Those are the top 5 options plays for the week. Hopefully you guys enjoyed those. Only high quality, high conviction companies. Maybe SoFi isn't for you, but there's a lot of people that love playing that one. It has good volatility, and now it's come down significantly off the highs, and it's very small, right? You don't have to go with 10,000 million contracts. You can go with one contract at a time. It's very small. It's about $1,000 for 100 shares. That's why I put it in there. But the rest of all the companies, they are all very high quality, high conviction stocks, right? We're not playing anything else in this market other than the highest quality names, because they tend to recover first after the initial phases of a correction. Now, if you want to look at some bonus plays, let's have a look at some bonus plays, shall we? The bonus plays is not that they're less good than the top 5. It's either that they're more volatile or just not ready yet. So let's look into them, shall we? So play number 1, guys, is going to be a very easy one. It is TLT, the 20-year bonds. Now, everybody knows that the yields have been high, and if you're looking for a Fed put, meaning the Fed to drop interest rates because tariffs will send us into a recession, then these bonds are going to absolutely fly over the next year. While we're at least sitting in the bond trade, if we get assigned, at least we're getting paid 3.71% dividend yield on our shares, which is paid monthly. So you have monthly reinvesting, which is always a good thing. Now, the TLTs are finding a local bottom right now in between $89 to $87. It is a fantastic area to go shopping. Now, I won't be giving you guys the expected moves. You guys are now experts at that. You can go on your own and look for the 0.5% rule overall, but I would not mind being assigned 100 shares of TLT 20-year bonds from $89 down to $87. I think it's a fantastic position to have in a portfolio as a hedge for possible macro uncertainty. Play number 2 is going to be Brookfield. This one I have in my own account. I have the $50 strike for the Friday session. We will see if I get assigned or not. But Brookfield, $50 down to $45. I'm a big fan of playing this investment managing company. Prior highs from 2022, you're looking for a monthly retest into a very large area of support. If Brookfield is a company you like, this is a very nice entry criteria for a first batch of shares. It is also not that expensive, and top to bottom would mean that you would be getting a 20% all the way through a 26% discount on those shares. Fantastic company. Company number 3 is Elf Beauty. Now, you may not like Elf Beauty, but some people like it. So for the people that like it, I am choosing to play it as well. Elf Beauty right now, very strong. Valuation, very cheap. 3.15 forward price to sales. Talking about a forward 15.7 price to earnings. 24 consecutive quarters of over 20% sales growth. They're gaining market share, and they're giving the legacy cosmetics brands a run for their money. At 68, you're talking about a 0.87 price to sales. Now, I know some of you may be thinking about the tariffs. Look at their forward EPS guidance. Look at their forward revenue. Will be expanding as well as they continuously grab market share. Now, keep in mind, this company has a lot of pricing power. Most of their products sell between $6 and $15. Let me ask you a question. When competing products sell between $20 to $40, Elf Beauties are selling between $6 and $15. Even if you put 25% tariffs on the final goods sale price of Elf, and you have a lip gloss at $9, do you think people are going to stop buying Elf because their lip gloss goes from $9 to $10.50 when the competitors' products are still selling at $20 to $25? No. If anything, people will substitute their Estee Lauder and their L'Oreal products and go to e.l.f. if consumer discretionary spending continues to get squeezed. I think it's a win-win scenario, even though the stock is very volatile. Down here, we have a beautiful range of support, 65 to 50. This is the area that I'm going to be looking to sell short puts on a short-term time horizon. Moving into another one, we're going to be looking at Pepsi. Pepsi, very defensive company. The company currently pays a 3.65% dividend yield. Pepsi still remains off its all-time highs by about 24%, which is not that often for Pepsi. They're trading below their 50 monthly moving average, which is also not so common for Pepsi. You put it on the quarterly. This is a quarterly chart, 3-month candles. Every candle, Pepsi very rarely trades below its 26 EMA on a quarterly basis. The last time, as a matter of fact, was in 2009. It is a fantastic opportunity to be picking up some Pepsi. Prior resistance highs from 2020 and 2021. This is the final area of support where the bulls found some very large bounces in the 148 to 140 zone. Is it a good opportunity to be going shopping for some Pepsi shares by the intermediary of short puts? Writing down here 145, 140. Absolutely. If you're looking for some value, some defensive names into these market conditions, Pepsi should be a prime candidate, especially with the fact that Coca-Cola is now way too close to its all-time highs and way far off the most recent level of support. I was giving you guys Coca-Cola for so long down here. Now it's ran too much. So now any plays for me moving forward will be on Pepsi. Moving on forward, we have another play, UPS. Now you might think that UPS has been coming down a lot since their all-time highs, and you would be correct. But look at the pricing, guys. This current resistance range, 2014 through 2020, is currently acting as big support for the bulls. Keep in mind as well, if ever we buy the stock, right? We're getting a 5.62% dividend yield. They are paying us for our time, very decent. So the valuation of the company is pretty good. We are looking for a cyclical rounding of the bottom in the company overall. And even if it drops a little bit more, guys, UPS, I'm going to be looking to go shopping 110 and below. 110 down to $100. I think the valuation down there is quite cheap for what they are. And overall, that would be a nice little entry, first entry for UPS. EPS expansion coming back for the next couple of years, and revenue expansion also coming back for the next few years. Decent opportunity to pick up a fantastic company overall, in my humble opinion. Now, the next stock we're going to be looking at is going to be Microsoft. Microsoft also needs no introduction. Now, this one is not for everybody because it is a very large play. But if you have a very large account and you're looking for one of the more defensive technology companies out there with an absolutely outstanding balance sheet, fantastic net margins of mid 30% range, and an EPS curve and revenue growth curve that looks like this. In the bear market of 2022, did their EPS go down? No. In the bear market of 2022, did the revenue go down? No. Microsoft just keeps printing money. It is too strong of a company. That being said, they're off their all-time highs by 17%. Fantastic opportunity to go shopping for Microsoft. The lower end of support is 378 down to 365. If we can get some short put orders into that region, I think a lot of you would be happy to pick up this company after maybe not having a chance to pick it up all the way down there. I'm a big fan of putting some orders down in this lower range. The next company is going to be another defensive stock, right? So a lot of people have been pivoting to defense and value stocks. Well, here's another one for you. Canadian Pacific. They are, for all intents and purposes, a duopoly in what they do. There's not a lot of companies, guys, that operate between the Canada, US, and Mexico borders in terms of transportation of goods, right? That being said, 72 down to roughly 66, not a bad first entry for CP. If we pull down and we want to write some puts to maybe pick up some shares, a very decent entry opportunity that is roughly 4 years almost worth of support. Bottom of the range. I love playing CP, and I'll be looking to play it a bit more in the future. Next, we have another value stock coming up, guys. Is going to be MO, Altria, tobacco company. Why? Well, because Philip Morris is just way too high. What are we going to do? Chase Philip Morris up here? No, I'd rather take one of their competitors that is very close to support. Top end of the range, 2019, 2020 retest. This is a breakout, possible retest, and possibly run. So we're not going to chase it up here. We're going to wait for it to pull back. $55 to roughly $52. Decent first entry for Altria. If you're looking for something like that, it pays a 7% dividend yield if assigned. So at least it's paying us for our time. Fantastic entry opportunity for this company. Even on the monthly time frame, guys, it's looking like it's going for the monthly uptrend. If it gives us one last little retest, could be a juicy area to be writing some options. Another technology company is Toast. I've been waiting for this one for a while after it came all the way up here. Now we're looking for a monthly uptrend, breakout, retest. If it comes all the way down there, 29 to 27, I'll be playing it. I played it myself last week. You can see the proof is in the Discord. We have the 29 puts for 18 cents. Now, they've since been they're since very profitable because Toast, I wrote these on the Thursday session on a big red candle, as we should. Now they rallied on Friday. Now my contracts are almost worthless. I can probably close them for 75% profit on the Monday. However, if Toast continues dropping, I think there's a decent opportunity. 29 to 25. Been waiting for it for a while, guys. If you don't know what Toast does, they do essentially what Square's business to consumer do. If you've ever been to a restaurant that uses Toast software, very good. EPS expansion right here. We also have significant revenue expansion, and the valuation does allow for some expansion as well. If Toast is a company that you like, I think that a retest of 28 to 25 has been resistance, guys, for the last 3 years. Come down into it for a first test of support. Yes, please. I'll pick up some shares. It's also very cheap. Another one is KWeb. Now, a lot of people have been pivoting to China with good reason. It is a natural hedge to possibly the erosion of US exceptionalism, right? I'm not saying whether that's the case or not. I'm just saying if you want to play KWeb, if we get a retest down here of the $32 to $30 range, could be good. The technicals look supporting of that as well. Retest of the range and then maybe expand into the 39.40 range could be quite decent. It is a now monthly uptrend. Any retest of this lower range could be interesting. That is roughly how many years, guys? 3 years rather of resistance. Now going to be acting as big support for the bulls. I'll be looking for a bit of a retest on this ETF to further position into some shares. Not a bad opportunity there as well. Then we have some oil companies. Now, I very rarely play oil companies. If you remember the last time I did, I was saying wait for the seasonal expansion. I know there's a lot of stuff going on between Russia and Ukraine, things going on in the Middle East, but overall, this is the last 20 years of data, right? From 2024 back to 2004, there's always been geopolitical things that affect the price of the barrel of oil. But one thing has always been true. When you come into March, April, May, and June, you come into agriculture season in the Northern Hemisphere, and people tend to travel a lot more, which results in a higher demand for oil overall. That being said, oil should be following a seasonal expansion pattern. So if you want to play oil companies, I've been holding off since the late stage of the fall season, which traditionally is the drop-off in oil seasonality. Now we're going for the expansion. So now is the time where we can possibly rotate to some of these companies. One of them would be Oxy. Oxy, decent level right here, $45 down to $40. Not a bad entry. Warren Buffett owns an absolute ton of this company. You can also look for something like an XOM 106 to 100. That is Exxon Mobil, of course, or even something like a CVX. All have two-plus year ranges if you are looking to write into support for some oil companies. Another one is possibly something like a Suncor. Suncor, Canadian company overall. I don't play it that often, but if it comes down into support down here, $30 lower, I'd start at 32, but 32 down to 28, guys. Very decent level for Suncor. I mean, look how long of support this is, since 2010. So every time we test it, decent entry area, and all these stocks pay high dividends, 4.33% dividend if we are assigned, and we have to wait with those shares before being called away. Then we also have another company, a real estate company like O Realty Income Corporation. Not often does it retest this support range. This support range can also be going all the way back to resistance, 2014-15, support, 2017, the COVID, of course, which collapsed and then came back. And then we also had some retests in 2023. If we can get some decent entry down here on $53 to $50, I might be looking up to pick some shares myself. And what better way to do that than writing short puts for a possible entry? And lastly, I have a Canadian bank for you guys. One of the banks that's been at support as well. Canadian bank right here, Toronto Dominion Bank, TD. A lot of you guys use it to trade. 4.89% dividend. Very attractive in these market conditions. And look, we are into huge support. Big resistance, 2017-28. Big support now for the last 3 years worth of trade. TD Bank, short puts anywhere 57 down to 53. Very decent entry if it's a company you've been looking to possibly acquire or want to sit in a financial institution paying a 5% dividend. Very good Canadian bank. That is all the top 5 options plays and all the bonus plays. Hopefully you guys enjoyed all of them. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new. We do these videos every Sunday in preparation of the upcoming week. There's something for everybody in these videos, so definitely subscribe if you want to see more. Lastly, if you have any questions on the strategy, please feel free to leave them down below, especially in times of big market volatility. If you have any questions as to refining the strategy or if anything's unclear, please let me know and I'll be glad to answer. And lastly, if you want to have all of my trades in real time, here are all the trades since the inception of the Discord. The green check marks are win, little tiny red marks are losses. I'm always transparent with all my wins and the losses. We started the Discord roughly 6-7 months ago at this point. It's been a very fun time so far. If you are looking to trade a similar strategy, but we don't only do the wheel strategy, we do also call options, put options, called credit spreads, put credit spreads, put debit spreads, everything, every option strategy, leap call contracts when the markets are in line with wanting to do those, long-term portfolio setups, long-term portfolio trades, swing share setups. We don't only do options, we also take a bunch of trades only using shares. If you want to be part of a community with over 150 similar members looking to consistently grow their accounts, not take on too much risk, and just run consistent strategies overall, maybe the Discord is for you. We also do private morning live streams Monday through Friday for about 2 hours where I trade live and answer all of your questions on your stocks, your options, and your long-term portfolios as well. If you cannot attend, they are all recorded. You can also ask me all of your questions in any of our chat rooms all throughout the day. I'm always very quick to answer to you for all your questions on your positions. And then after, we also have private videos where I go through a lot of these different advanced strategies that I don't show on YouTube, advanced wheel strategies, other advanced option strategies, how to grow accounts in a consistent and somewhat, not very risky way over time. All of these videos, guys, have been providing our members extraordinary value. And you also get access to all my watch lists, my options watch list, my value watch list, all the watch lists that I show on the channel, and all my charts, all the technical analysis that you see on over 100+ different charts, all of the annotations as well. When I take a look at these earnings fundamentally for all these companies on over 100+ different companies, you get all of those with a click of a button. You just copy paste, you get all my watch list, all my charts, comes with all the annotations. All that is included in the Discord. If any of that sounds good to you, the link is down below. And if not, well, I guess I'll see you back on the channel, guys. Pleasure as always. Have a very good week of trading. That's it for me. Take care and peace.